Okay, here we go. Hi, everyone. Thank you so much for joining us for today's session. What business owners need to know about financial planning. We're going to talk about some great topics, stages of business, things you need to consider as you're moving along. A lot of it's particularly relevant given our challenging times right now. Our speaker, Roxanne Arnall, is really excited to share her knowledge with us. She's got a ton of knowledge, and I really like her approach. So Roxanne, you are live.
Okay. So I was saying, if anyone watches my LinkedIn feed, today I'm talking about how tech is my friend, and there are days like today where I just have to keep reminding myself tech is my friend. So thank you, Clayton. I am running with a few different challenges today, so hopefully we can get through that. So thank you, everybody, for joining us. There's a lot of content on today's topic, so let's get started. So we are really focusing on small businesses here today. And really, a small business always starts with you. At every stage of your business, you indeed are the catalyst. And when it comes back around, you need to understand what your next chapter is going to look like. So we're going to cover a little bit of that today, too. So this is your financial house. And it all starts with a solid foundation. So we will always start with a plan that's centered around your goals and dreams. Then comes the legal documentation that we need to support that plan, followed closely by our risk management strategies that are necessary to prevent the house from crumbling down. And only after we have established the foundation and the ground floors can we move into wealth creation, management, and transition. So let's take a moment to discuss the startup phase. Having a clear picture of your dreams, both professionally and personally, is key to setting up the initial foundation. Do you understand your business plan? Are you receiving a fair offer from your lenders? How will your personal cash flow be impacted by your business decision? When you can start to remove cash from your business, do you do this via salary or dividends? Understanding the difference is truly key. Pro tip, salary creates Canadian pension plan credits as well as RSP contribution room. Unfortunately, the dividend tax rate is now near perfectly integrated. So the benefits that we once saw prior to 2017 are no longer that same perk. There are a number of legal documents that you should also set in place, even at startup. Should you set them up as a corporation or as a proprietorship? Pro tip, there are costs to setting up a corporation, and the legal protections they offer can vary. Creditor protection is a key feature for most people in setting up a corporation, but this is not an option for professional corporations. Those are what's used by doctors, optometrists, and accountants. The other big advantage of a corporation is the ability to access your lifetime capital gains exemption when it comes time to sell your corporate shares. So are you starting your business alone or with a colleague? Another pro tip here. Anytime there is more than one person involved in the ownership of your business, it is absolutely critical to ensure that your joint venture or unanimous shareholders agreement is signed right from the start, and that you have not only discussed the areas covered with your accountant and your lawyer, but also with your financial planner. I cannot tell you the number of times I have seen serious issues with an agreement that has already been vetted by your other advisors. So it's just worth having that extra set of eyes on it. So what kinds of things should be addressed in such an agreement? What are the conditions of a forced sale? You need to provide for the transfer at death, in the event of permanent disability, at retirement. What happens if one party violates the shareholders' agreement? Are these items spelled out properly? Will the sale be mandatory or optional? Shotgun clause, the existing owners must be offered a chance to buy the shares before a sale to a third party. Are there going to be children of shareholders involved? Does it include reference to transfer of existing life insurance on exit? Valuation and price. A formula for valuating your shares should be included in the agreement. I particularly like formula-based agreements. Does it conform, though, with the standards for your type of business? Does it call for an arbitrator like an accountant or a certified business valuator the opportunity to input in lieu of a formula? This can certainly become important as time goes on and as your business grows, perhaps exponentially. How will those exit strategies be funded? Are they be funded with corporate or personally owned insurance? You want to make sure that the ownership conforms with the terms written in your agreement. Does the agreement allow for annual reviews and updates on the amount of coverage? What type of insurance policies will be used? We have seen instances where as value goes up, one of the shareholders suddenly decides they don't want to add additional insurance. They don't want to be underwriting. They don't want you as the partner to know that they have become sick or that they have a bad driving record or other issues affecting insurance. So making sure that partners agree at a time before any of these things show up that you're going to continue to move forward and have insurance funding to match your needs as a mandatory written in on your shareholders agreement is key. What are the payment provisions? So you want to include details of how the remaining owners are going to pay for that business interest. What are the terms of those payments, the interest rates, security on the loan if insurance proceeds are insufficient to complete the funding? Do these funding provisions actually align with other provisions of your agreement, such as the utilization of the capital dividend account? We're going to get into that a little bit more later, but how that's written in on this agreement is going to matter. On the legal document side now, as you're building business assets, it is important that you also update your personal documents to reflect your new world. This is no longer about you just bringing home a simple paycheck anymore. On the risk management side, you really have to make sure you've reviewed all the what ifs, not just for shareholder agreements, but these are also important conversations for your family and your work team as well. These can be tough for many people, but being able to discuss your desires and plan of attack at a time when the threat isn't a reality is the best time to do it. It allows us the opportunity to make decisions with a clear mind outside of panic and fear. And I've seen it happen. I've seen it happen where one partner just stops coming to work because of a mental disability. Everybody thought they'd be able to handle it, but when push came to shove, they didn't know how to handle it. They didn't have a guidebook written in on how they were going to deal with that situation. Super important to talk about these things before the issue happens. There are so many areas of risk to cover off, and I know it can be daunting. There are various liability protections for life and living benefits. You want to keep in mind the function of insurance is to protect you, your family, your business, and the assets you are growing. I know a number of people aren't fond of insurance, but I want you to think about it like a GoFundMe page before the crisis hits. Premiums are gathered from many people in the same risk group to create a pool of money to assist those in your group when the time of crisis arrives. It's taking responsibility for your own risks and is truly a key feature in proper planning. One area that often comes up is creditor insurance. This insurance is typically offered by your lender, the bank, at the time of your loan application. Many people feel they have no choice, but it is illegal for the lender to tie your loan to their sale of insurance. So in this graph, you'll see how, as time goes on and you have been paying down your loan, that the insurance coverage also goes down. Should a claim be made, the lender will receive the benefit should you qualify for coverage at the time of claim. Yeah, I said it, at the time of claim. Often creditor insurance provides you with a false sense of security as the coverage is only underwritten at the time of claim, meaning that you can be denied your claim for a number of things. Historically, creditor insurance has paid out only about 10% of claims because of this delay in underwriting. Not to mention that this product, where you pay the premiums, your lender gets the benefit. Pro tip: if a lender requires you to secure the loan with insurance, whether it be disability, critical illness, or life, it is always best to have individual insurance. You can collaterally assign the policy to the lender if it's needed, but you maintain that control. You maintain the benefit. And individual insurance provides you with immense flexibility as time goes on when we set it up correctly. This will become a huge factor because our insurance needs typically change over our lifetime and the life of our business. In addition, the insurance will stay with you if you switch lenders, preventing you from having to requalify if your health changes. The coverage benefit doesn't go down as you pay off the loan. Individual insurance premiums consider good health and lifestyle as underwriting at the time of application. This can lower costs, but you also know that you have coverage according to the contract definitions. And selecting a convertible policy locks in your insurability now for your future options. There is no doubt that the best time to buy insurance is when you don't need it, when you are healthy and young, not after you've had the heart attack and are now scared. And yep, at least once a year, that's when a person shows up wanting to buy insurance. So what's the risk? Whether you realize it or not, we are all at risk. Nearly half of all Canadians will experience a critical illness, a disability, or die before the age of 65. This statistic here shows the risk of an average 30-year-old non-smoking male of becoming disabled, critically ill, or dying before age 65. And it's actually a little worse for women. I want you to be aware that these are not just stats on paper. These numbers are real. And I can tell you from our own household experience, my husband suffered from a heart attack at age 50. And I was diagnosed with cancer at 48. We both suffered a critical illness. I had a disability claim. Because what used to kill us in the past, we are now surviving. My husband and I are poster children for this. He was lucky. I was with him in the truck 5 minutes before his symptoms started. Sorry, we were 5 minutes from the hospital in the truck before his symptoms started. I was there. I was able to drive him directly to the hospital where he was able to get care immediately. I was fortunate because I saw the right doctor at the right time who fought for a diagnosis for me and a treatment for a cancer that previously had had 0 survivors past 6 weeks. That was 2.5 years ago. These numbers are real, and we are extremely fortunate to have been able to survive both physically and financially. So yes, disability plans and critical illness plans are more important today than they ever were in history. There are a number of options, all with different focuses, features, and benefits. So having honest discussions with yourself and your advisor will help to protect you, your family, and your business. We could have a whole series of webinars around types of insurance and what key features to look for, but please be aware that the options and features on a policy are so important. If you are interested or have questions, please feel free to contact me directly. So what is the cost? So here are a couple of pro tips I want to share with you on insurance. Number one, apply when you are young and healthy. It's just so much easier to qualify. Number two, protect your insurability. Getting coverage today to help protect your future. These are affordable options. There are affordable options to fit every situation. Ensure you have coverage that can grow as your business does. And four, understand what policies should be business owned and which should be personally owned. It makes a difference, particularly when we focus in on taxes. In a business, you can set aside money to cover the expenses if you, your business partner, or a key employee were to get sick, injured, or died. But is this the best use of your hard-earned money? As we move into the next phases of the business cycle, I just really want to focus on what is new. That doesn't mean what applied in the startup phase still isn't important. It all continues to need to be updated. But there are some new issues that come up as we grow. So in the growth phase, what are the next steps in your growth? Does it involve partnership, expansion? What do you do with excess cash flow? Do you need to take on more debt? How are you going to recruit top talent? With more cash flow, there are more questions. What are the best means to invest, both inside and outside your company? Pro tip, active business generating corporate investments are almost always wise as they enhance expansion. Remember, active business. However, passive income generating corporate investments for long-term savings or retirement are typically best done only after all personal tax advantaged investment accounts have been maximized. In the legal document world, at this point really depends on what your next steps are. We'll have different legal requirements. On the personal side, though, by this time, you're often dealing with some new issues. And I will warn you, one of the biggest decisions you will ever make in your life for both your overall happiness and your financial affairs is to choose your spouse wisely. Key advice. I've told my children, at this point, we don't have to worry about it, but we constantly reinforce that choice. And who you choose to align yourself with is so important.
Okay, so hold on now. Do you have the formula, Roxanne?
Well, let's see. Am I the best person to give advice on that? I was engaged at 18, married just before my 21st birthday, but on the upside, we have been married 30 years. We really did grow up together. But choose wisely and look at the family of the person you're getting involved with, because that's going to tell you a lot, right?
All right.
Do they
well,
treat
I believe you are qualified to give advice on that then. Thank you.
Thanks. On the risk management side, like with your legal documents, additional risk management you need, again, really depends on what that next step on expansion looks like for you. Protecting your cash flow, though, remains critical. So, pro tip, always review your property, commercial, and your errors and emissions coverage, both on the replacement values attached to them, but also on the liability limits. It amazes me how many times people just renew year over year without ever opening up that policy, without ever having a good advisor come back and visit with their business and say, hey, what's changed? What do we need to update here? It's important.
It's really interesting that you say that, because I think a lot of us in the back of the head just go, okay, I dealt with that, like that's, and then, but if you take a serious look at when I dealt with that, it's like, holy smokes, that was, 12 years ago. But there's just like this lingering, I guess, maybe fear of having to address it again or whatever it is. And you think you've already dealt with it. And so, you just sort of leave it. And I see that a lot too. And I think in some instances, I'm guilty of that. So, it's a great point. It's like we need to not be scared. But I think also having a great advisor that you can feel comfortable going to at your various stages is really important as well. I'll shut up now.
No, I think you bring up a good point. And I think what a lot of people fear when they open up those conversations is the fact that they're going to pay more premiums. On a lot of that, on property and casualty, premiums go up, unfortunately, constantly. And if we have to even increase our limits, most of us don't like to do that. But the liability side is so critically important. So paying no more, though, than your fair share of taxes also is critical at this point. And as Clayton, I'm sure you can attest to, many of us pay too much tax because we aren't aware of how the proper structuring of our affairs plays such a key role in maximizing all the programs and the legal tax sheltering options that are available to us. Another pro tip, using life insurance as part of your fixed income investing can save you a lot of taxation in retirement and still provide you with access to your money for lifestyle goals while still leaving something for your legacy. Another pro tip here, there are also tax efficient ways to set up your critical illness insurance policy that allows you to receive funds from your company to your pocket tax-free if you remain healthy. So some real keys in there and ideas that are all legal. So I'd like to spend a little bit more time here on that buy-sell agreement. This is the one where we talked about some of the provisions to put in it, but it's really how are we going to make that legal document that describes how the business owners will respond to a number of given situations. How are we going to ensure that the business continues in creating the job security for your existing employees, in laying out the obligations of the owners, and ensuring that the business won't suddenly become controlled by a spouse or heirs of a severely ill or deceased owner? I can tell you, we rarely want spouses involved in businesses unless it's already a family business. So despite the importance of the legal wording, it's also super critical that those events are funded. So if you or your partner becomes disabled, there needs to be a mechanism to fully or at least partially fund the buy-sell agreement. Insurance can immediately put money in the hands of a disabled shareholder for personal expenses, but business-owned plans can also provide money to keep the lights on, pay your loans, offset against the potential loss of income due to absent individuals, cover the cost to recruit, train, and hire employees. Will your business also suffer a loss of customers and employees? So a change in creditor and supplier relations. The policies can also be set up with wording in the agreement to aid in establishing a fair price for the business on required exit due to disability. The reality is that the cost of insurance will be far less than the cost to self-fund the buyout. When you have to outright pay for the buyout, the costs are further compounded by the effects of taxation. So let's look at an example of the cost of death of a business partner. Let's first look at the cost to the company. If you ask a shareholder what it would cost to purchase the shares of another shareholder, they often state the share value. That's fine if you have the money sitting there for it. Pro tip, that's probably not the best use of your money, by the way. However, in many agreements, the share purchase happens over a few years. This results in interest payable on the outstanding balance. The payments on the share purchase are also made with after-tax dollars. If the business owner takes into account the costs of sales and expenses to arrive at a revenue amount needed to generate the after-tax capital for the payments, the numbers can get quite staggering. If a company, for example, needs $2 million of capital for the share purchase, generating that capital through revenue, the company would pay $666,000 in tax using our current general corporate tax rate in Alberta. Yes, there is the small business deduction tax rate of 11%, but to generate this kind of money, you will need to have earnings in excess of that $500,000 annual small business deduction limit, likely. If we use a modest 3.6% interest on the payout, costs over 5 years would equal just over $251,000. So the total amount of capital needed to complete the buyout utilizing cash is almost $3 million, or 146% of the share purchase in this example. All this assumes that the death of the shareholder did not have a dramatic impact on the revenue of the company. So I ask you, are you willing to give up the first $3 million of revenue in order to purchase shares? Or would you prefer to pay an insurance premium, here illustrated at $110 a month on a $2 million term priced initially for a 30-year-old non-smoking male? If you took it to the end of the 20-year period, the cost of funding the life insurance policy is still a fraction of the cost to self-fund the death buyout. Is this truly a risk worth taking? Pro tip: insurance provides money to carry out the buy-sell agreement if you or your business partner dies. It is generally more cost-effective than using profits or loans. It can be set up so there's an increasing death benefit to account for increasing share values over time. And a corporate beneficiary receives most of the death benefit tax-free. Corporately owned policies also have the ability to pay out tax-free capital dividends. And there is still the cost to the survivor's estate to consider. Pro tip: here is where the importance of that capital dividend account wording in the buy-sell agreement matters most, and how the capital dividend account credits can allow for tax-free redemption of shares upon death. Without utilizing the capital dividends, a significant tax bill may be payable. Contrast that to an insurance solution whereby the necessary capital dividend account credits are utilized to employ the spousal roll and redeem method, and all tax can be avoided. As a business becomes more established and cash flow is improving, a conversion to permanent life insurance from the term insurance typically purchased during the startup phase offers some tax benefits moving forward, like tax-free growth that can be used to fund retirement or to help keep pace with that business growth. And create that capital dividend account deposit on death. This too occurs with term policies. And all insurance premiums may be tax deductible or at least be paid for with a small business tax dollar. I think we can all agree that an 11% tax dollar is far better than our personal, at the high end, 48% tax dollar. And there are some other benefits to permanent insurance as well. So it's truly key to understanding your goals, both personally and in your business, to find the right strategy and the products that meet that solution. The benefit of growth is we can now really start paying more attention to that wealth creation. Pro tip: take salary up to the RSP contribution limit. All funds that you take directly from your company as salary and roll into an RSP are tax-free until it comes time to use those funds in retirement. And with good tax planning, we can continue to manage that tax bill. There is no substitution for investing early, however. So in both cases here in this example, we've deposited $480,000. $1,000 a year starting at age 25, or having to double that if we don't start to age 45. Yet when you start early, you have almost double the amount of money by age 65. Not to mention that when you start early, the volatility ride, as most of you have seen with our markets, particularly this year, it's a lot easier to handle emotionally. So what are some of the tax advantage ways for us to create wealth? If you were able to attain the full required taxable income to meet the maximum RSP contribution limit by age 25, and continued this pattern until retirement, you could have nearly $4.5 million in your RSP alone at age 65 using a 5% rate of return. Fairly modest if you think over 40 years. Yes, it's taxable income, but it has been tax deferred, which has allowed for greater growth along the way. And if we remove these funds in a tax efficient manner in retirement, we can also manage that tax bill moving forward. I know what you're thinking. When you take salary, you also have to pay into the Canadian pension plan. And isn't that just another 10.5% tax for self-employed people? Well, if we go back to utilizing that RSP maximum tax salary, and we realize that people meet the maximum CPP contribution limit at an income of $58,000, $58,700, if we math it out on that maximum RSP contribution income of $151,000, it really only works out to 3.83%. Based on these contributions, if you started receiving CPP at age 65 and lived to age 90, you may receive just over $450,000 in CPP benefits. It's a pretty nice form of a base income for retirement. And let's face it, it's not really a tax, it's just forced and consistent retirement savings program. So it's not a bad thing. And let's not forget our favorite friend, the tax-free savings account. So if you take that RSP maximum income amount again at $151,000, and if you can live on $6,000 a year less, so just $500 a month less, and you invested it in a TFSA, and if you kept increasing your contributions to the annual maximum based on our expected increases from ages 25 to 64, you would have deposited a total of $359,500, and at a 5% rate of return, you'll have just over $1 million of tax-free money at retirement. That's what I like to have in my discretionary income pot. So to recap, what are the keys to wealth creation? Regular and diligent savings, using tax-favored vehicles, investing in businesses you know. Those are your own businesses, but also businesses that are difficult to compete with, difficult to replicate, difficult to live without, and that are purchased at the right price. So moving into our established phase of the business cycle, what does that look like for you? Does it involve a partnership, an expansion? How are you going to efficiently deal with your excess cash flow? How are you going to ensure that you retain your key employees? And I can tell you from my own personal experience, this was my #1 fear. I had created a business that required more of me. I had associates, and if I lost them, I was going to be overworked beyond measure. This scared me. It scared me so much that I made some of the worst decisions of my life. Decisions around changing my shareholder structure, decisions that were not challenged or explained to me by the advisors I had at the time, who did not address the concerns I should have really had, who did not ask about my lifestyle and legacy goals. I made decisions that ultimately led to my selling the entire business. A business that I grew that ultimately led to my exit. So yes, key employee retention is a real factor to plan for. Start working on your retirement and succession planning well ahead of time. And lastly, don't forget about your legacy. What is it and how can you best plan for it? There are some additional ways that you can also bump up your retirement funding. And how you step out of your business will be critical to maximizing the financial asset of your life's work. Pro tip: it is vital to prepare your business now for your desired transition. Transitions can take upwards of 10 years, so it's never too early to start, and the earlier you start, the smoother the transition for you, your business, and the clients you serve. You want to review and update your personal and business documents regularly. These are still a part of the solid foundation you need. Executive benefits for you and your key employees should be reviewed. The group plans that you may have put in place previously don't keep pace with higher salaries and aren't enough to compete in today's market. Pro tip, we can consider shifting our risk management insurance policies to those more permanent needs of wealth strategy, tax planning, estate equalization, and charitable giving. Remember, if we set up the right structure, we can adapt our insurance protection through all the various stages of our business to meet the changing business needs and personal needs over our lifetime. Wealth creation can take on bigger steps. Pro tip, catch up on those past carry forward RRSP and TFSA contribution room. As soon as you started filing tax returns, even those from your 16-year-old job, you started to earn RRSP contribution room. And as soon as you turned 18, you started to earn TFSA contribution room. You likely didn't have the means or the need to utilize those programs then, but now you can take advantage of that carry forward room and always maximize your personal tax advantage vehicles before you look to corporate ones. On the corporate side, you can enhance your RSP program by adding an individual pension plan known as an IPP. And part of preparing for your transition is to clean up your corporation. This may involve using a holding company, transferring certain assets, controlling your inactive income. This is purification time. The sale of the shares of a qualified small business corporation also make you eligible to take advantage of the lifetime capital gains exemption. Pro tip, to maximize your after-tax proceeds from a business sale, a corporate share sale needs to be a qualified small business. So you do need to plan ahead, because who doesn't want a nice chunk of tax-free money?
2 years, for the record, 2 years. We need to know about this 2 years beforehand.
Minimum. And that takes us to
yeah,
the next
sorry, you're
step.
right. Whatever stuff we have to do to get that purification done needs to be completed 2 years before the share sale. So
yeah. And nothing happens fast. Holy moly.
Oh no, but we all think it's going to happen fast. You know, we should just, let's write it down on the back of a napkin and we're done tomorrow, right? It never happens that way.
I wish. So let's talk a little bit about this next chapter. So why is the next chapter so difficult for so many people? Most business owners are not aware of their exit options and what each option means. What are you transitioning to? Having a clear picture of your dream for the next chapter is key to avoiding regrets and having resentments about your business transition. The transition is a lot easier if you're excited about the next chapter. So, can you answer those big questions? Will you have enough? Will it last? What happens if? Where are the risks? What can go wrong? This is a chapter that wasn't clear to me when we sold our practice, and I spent years figuring out why I wasn't happy after the sale. Mostly because not one of those advisors took us through the lifestyle and legacy discussion we deserved in order to answer those big questions. Exit readiness is a process. There are personal, business, tax, and cash flow implications that should be considered for all your options. I truly can't stress this enough. On a share sale, you can take advantage of your lifetime capital gains exemption. You might need to set up a holding company to continue to hold certain assets that you aren't going to transfer with the business. A share sale does make it easier for business continuity, invoicing, and contracts. But the new owner also takes on the liabilities moving forward. So they may want compensation for your past risk. This includes severance requirements of your ongoing staff. In an asset sale, you don't get to take advantage of that lifetime capital gains exemption. You may need to convert your existing company into a holding company in order to continue to hold assets that are not going to be sold. You need to maintain liability moving forward as for your past discretion. So typically all staff are going to be fired in an asset sale. You need to pay them severance as the previous owner. And they may or may not be rehired by the new owner. So that may pose some additional concerns for you and the team you're leaving behind. And you may also be required to continue to maintain your errors and omissions insurance over the long term. If you're doing just a partial sale, again, you're going to need some of those legal documents we discussed earlier. You're going to have means of funding those. If you're setting this up for the first time as part of a transition, you're also older now and you may be more difficult to insure. Premiums are going to be more costly. You're going to be maintaining liability moving forward. This may ease your transition into the next steps because you're not completely cut off from the business, but it can also create additional challenges because now you're not the only one making decisions. And a lot of those decisions are going to become increasingly out of your hands. Can you adapt to that? In the end, you may also just have to shut the door, liquefy the hard assets, and you're going to lose your life's work. That can be an additional hardship for you emotionally, but if you were relying on that money to fund your retirement, now you also have a liquidity problem for your future cash flow. Planning every step of the way helps to ensure you can answer the big questions with confidence. We must first seek to understand. Every solid piece of advice we give must start with a thorough case history. What does the money need to do for you? We need to gather the data, review it, look for solutions, ensure we are creating answers for all the key questions, including those questions that you didn't even know you should have. We need to bring our expertise and our experience to the table every time. We need to present the solution and the situation in a language that is understandable and relatable in order to make truly informed decisions. Ultimately, our goal is to take care of you completely, to have confidence that your needs are being taken care of, to provide you with peace of mind. So you can see how planners assist you with far more than the numbers. We ensure that you have looked after what truly matters most and provide you with the information you need to make smart financial decisions. With proper planning, we can see the whole picture. I work with a team of specialists covering areas of most critical impact to your life's work. These best fit partners for your insurance needs, some key accountants like Clayton, lawyers specializing in acquisitions and debentures and estate law, and certified business valuator, all with the goal of enhancing the lives of our clients. Because financial clarity truly is a beautiful thing. Thank you.
Well, thank you, Roxanne.
Hi.
I've got the question box open here. I haven't got any questions yet, but I just want to refer back to a couple points in the presentation. You did a good job of pointing out, there's a dividend versus salary conversation that we're having a lot, and that dynamic has changed dramatically. For anybody who wants to dig in a little bit deeper on that issue, I wrote a very lengthy 3-part blog. I'd hoped it would be 200 or 300 words. Yeah, right. But anyways, it ended up being a 3-parter because it's so in depth and in detail, all the things you need to consider. Go to that max RRSP limit is a great broad line advice. But if you are hoping to get some UCCB from the government, federal government, you want to think about that stuff, and maybe you've got some other benefits coming at you that'll start to get clawed back at other income levels. So, that's where you really need to have a holistic approach to this, and it's not as easy as just attending a webinar and picking a salary level, right? We need to understand your whole situation. Other than, it's just so amazing what you bring to the table, Roxanne, and your approach, and I really appreciate that. Sorry, there's some light on me. And so, Roxanne, I guess, first of all, thank you so much. It's obvious that you really know what you're doing, and you've thought through this, but not only as a financial planner, but as an entrepreneur. I mean, you've been through this, and as you mentioned, you've got some regrets there. And so, you're a little bit invested in making sure that folks don't make, I guess, potentially the same mistakes you made. And so I really appreciate that about you. This stuff's pretty scary to me. And so is there a way that I can just kind of dip the toe in the water with you to start a process of, investigating what's possible in my situation? What are your thoughts on that, and how do we go about that?
Yeah, like I mentioned, it really all starts with what I call clarity. So it's needing to understand what your goals are, and that in itself can be tough. People don't always have clear goals when they start out. If I think about when I started our optometry practice, all I knew is I wanted to buy a practice. I didn't know what that meant. I didn't know what growth would be like. I didn't necessarily have dreams for what that would look like as time goes on. So we don't always know all those pieces at the beginning. And I think that's where a good advisor and having a good team in your corner is key, right? We're going to ask you questions that you hadn't thought about. And when you can get your advisors together, nowadays that means Zoom meetings, but get the accountant and the lawyer and the planner together, we can review your documents. You're putting together 3, dare I say it, brilliant minds to make sure we haven't missed something, because that's really important. Working together.
Even the prospect of that is scary. I mean, what if I just give you a call? What is the process? Where are you taking me first?
Step 1, we need to figure out your goals. We need to do some goal digging.
Right. So I want a place in Fernie, or I want to retire at 55, or whatever those goals are, right?
Yeah. Always starting with goals.
By the way, those are my goals, but I'll probably end up retiring at about 75. So.
And again, what does retirement look like? When we have those initial conversations at 25, it's very easy for people to say they want to retire at 55. As someone who's getting fairly close to 55 now, I can tell you I don't want to retire. I have more desire to keep working and doing what I'm doing now than I did 20 years ago.
Sure. Yeah. Things change. Yeah.
But I do want flexibility.
So how often am I checking in with you? During the execution of a plan? Are we talking every year, every quarter? How does that work?
Depends what's all going on, right? If things are running and we're just kind of in, dare I call it, the tickety-boo movement, it might be as little as once a year. Yeah. But if we're in a process of significant changes, it may be more often. It might be quarterly. It might be every 6 months. If we're really working on wealth creation and looking at your investment plans, we want to review those regularly, especially in volatile markets. We want to make sure you're still allocated correctly, right? That's a whole nother conversation where we utilize, wealth planning in a different way. But from a business planning, minimum once a year, anytime any major life thing changes. You have a baby, you have a business association change, you gain a major contract, you lose a major contract, right? Yeah. Big things that are going to impact that cash flow, because I want you to be able to walk away knowing that you made a smart financial decision with all the information you had. And a smart decision doesn't always mean it equated to the biggest amount of money at the end of the day.
No.
But that's just one of the factors to make sure you understand in that.
Well, decision. I think you hit it right at the beginning when I started down this line of questioning, I guess, is, you said it's really about your goals, and that's what we're finding. We find as well at Aiken Henderson when we're talking to business owners, it really is about what they want. And a lot of times people don't want just the maximum amount of money. There's a lot more to it, right? They want an element of personal freedom, or they want to help their communities or the public in some particular way. So the goals are varied. Two things. One, if anybody has any questions, please get them published. We're going to shut this down here pretty quickly, and there is a 20-second delay. So if you wouldn't mind, pop any questions over. Roxanne, if you could throw your contact details back up just so that I could show them to the group one more time. And then the last question that I had for you is, what does your deliverable look like? So we engage and you start understanding who I am and what my business is about and what our family's goals are. What are some deliverables that we can expect from you on an ongoing basis, and in terms of what does the relationship look like?
Yeah, thanks, Clayton. One of the big ones is, making sure that we're bringing the right other specialists to the table. So you may not know a certified business evaluator, right? I can connect you with those people, right? You may not have a lawyer that deals with acquisitions and debentures, right? There are people out there who have a great deal of experience. So that's one of the things that I think is super important. And the other is just somebody there to be your sounding board. When we talked about the markets really dipping earlier this year, one of the great illustrations I saw was a great little sketch figure, but essentially I'm the person that stands between you and your next bad decision.
Yeah. And I'm also thinking of, we worked on a mutual client, a few, but I just remember seeing one of your beautiful binders as well, right? So, it's not all rainbows and fairy tales. I mean, when it gets down to it, you're actually giving some real concrete deliverables as well, aren't you?
Yeah, like the binders I create for my clients have many facets in them, and one of them is a legacy tab. But the legacy tab isn't always about charitable giving, which is what many people think. It's going to have a sheet in there that basically says, if you're not able to speak for yourself, does somebody else know where to find your stuff? Where are your accounts held? Where do you hide your safety deposit box key? Simple things like that we don't always think about. Where is your password keeper? We're getting more and more digital assets now. Does anybody have any idea how to get into them if you can't?
Yeah, that's a really good point.
Yeah, so that's one of the pieces of the binder, right? Just keeping track of your contributions, keeping track of where your different pensions might be from past jobs, little accounts, consolidating those, because those ones really are easy to get lost, particularly if you move between provinces. You left a job years ago and, oh, look, there was a little RSP there that everybody forgot about because you moved and the mail doesn't get to you anymore.
We do have one sort of tax question in here, and then we'll wind it down because we're bumping up on the hour. Does short-term borrowing of excess corporate money to invest and pay tax in personal accounts make sense, provided RSPs, TFSAs are full? The loan will be repaired prior to the corporate year end with the goal of making use of the excess corporate draw and reducing the need for draws. Excess corporate cash and reducing the needs for draws. There's some tax issues there, but I'll shelf that for now and I'll let you go.
You read that fast. I'm just going back now to read it.
Okay. The short-term borrowing of excess corporate money to invest and pay tax in personal accounts makes sense, provided RSP TFSAs are full. These loans would be repaid prior to corporate year end with the goal of making use of excess corporate cash and reducing the need for draws. So somebody's really talking about doing a short-term loan from their company for short-term personal investing purposes.
Yeah. At some point, if your RSP and your TFSA accounts are completely capped up, there are certainly some spousal loan options that you could kind of play with and do there, utilizing prescribed rate loans.
Well, that assumes that the money's already out of your corp. I think in this scenario, the money's still in the corp. I guess the challenge here with this one is, from a tax perspective, is money borrowed from your company is deemed to be income at the moment that it's borrowed. The the person who typed this question in obviously has some idea of the Income Tax Act, because they're saying if we repay it before year end, and they're doing that to not run afoul of these personal loan rules. But the challenge with that, I would think, from an income tax perspective, is if you're doing that annually, the CRA is going to view that as a series of transactions that's related, and they're going to deem that to be income to you personally within that fact pattern. And so, that's where the tax problem comes in. If you do it once, maybe it's okay, but if you're doing it year after year, you're going to run into some problems with the shareholder loan rules in the Income Tax Act. So,
yeah, the only other thing I want to add there is anytime you're borrowing, whether it's from your own corporation or from a bank or anything to invest, you're taking on additional leveraging risk.
Totally.
So it's easy to say you're going to pay it back before that year end. Pay it back with what?
And then the market crashes and you can't get out. And anyways, okay, so here's Roxanne's contact information. Roxanne, thank you so much for volunteering your time to get some good informations out. I think everybody found it very useful, and I think everybody's got a good flavor for your level of expertise. So thank you so much.
Thank you again for the opportunity, Clayton. It's been enjoyable working with you.
All right. All right, everybody. We'll send a follow-up email with the replay link. Thank you for attending.